Picture this. You put money in the bank. You assume it's stored somewhere safe. A vault, a box, a place. It's not. Most of the money you use every day was never printed, never touched, never physically existed. It was created quietly, legally, by banks. And almost nobody notices. This matters because inflation, housing prices, debt, and financial stress all connect to this hidden process. So let's simplify it. One question: where does money come from? Most people say governments print it. Central banks run the presses. That's only a small part. Cash is less than 10% of modern money. The rest is digital, numbers on screens. And banks create most of it. Here's how. When you take a loan, the bank doesn't hand you someone else's savings. It doesn't check a vault. It opens a computer, types a number, your balance goes up. At the same time, a loan appears on the bank's books. New money now exists. No transfer, no cash, just creation. This is normal. This is the system. When banks lend, money expands. When loans are repaid, money disappears, deleted. That means most money starts as debt. No borrowing, no expansion. This is why credit matters so much, why interest rates matter, why confidence keeps everything moving. Now zoom out. You buy a house with a loan. The seller deposits that money. That deposit supports more lending. The same money fuels multiple transactions. Not infinite, but powerful. That's why asset prices rise faster than wages, why housing booms feel unstoppable. New money chases limited assets. Here's what people usually get wrong. Banks don't wait for deposits to lend. Deposits usually come after lending. Banks create first, then stabilize later. Now the constraint. Why doesn't this spiral forever? Because banks can only lend if people want to borrow and believe they can repay. When confidence is high, money expands. When confidence breaks, lending slows. And when loans are repaid, money vanishes. That's why recessions feel sudden. It's not just fear, it's math. What about central banks? They don't create most money. They influence how much banks create. They set interest rates. They provide support in crises. They steer. Banks decide. Lower rates encourage borrowing. Higher rates slow it down. But central banks can't force lending, and they can't force borrowing. So money flows where lending feels safest, usually into assets, not everyday life. Now the uncomfortable part. Every dollar created through lending comes with interest, but the interest isn't created at the same time. So the system depends on constant expansion. Growth isn't optional, it's structural. This doesn't guarantee collapse, but slowdowns create stress fast. Now compare this to the story we're told. Banks as simple middlemen, money as neutral. That story is easy and wrong. Banks are creators, and creators shape outcomes. They decide who gets access to new money and who doesn't. That power is quiet, but real. It shows up in inequality. Those closest to credit benefit first. Those farthest feel prices rise without upside. Same system, different results. Now bring this to today. High debt, tighter credit, fragile confidence. The system still runs, but with less room for error. So here's the thought to leave with. If banks create most money, and money shapes almost everything, who should control that process? There's no simple answer, but once you understand how money is created, you start noticing when it disappears. So next time you check your bank balance, remember, that number isn't just money. It's a promise, a debt, a system breathing. And the real question isn't whether banks create money. They already do. The question is what happens when they stop.